Most traders believe the market is random. Elliott Wave Theory challenges that belief. It says price does not move randomly. It moves in repeating psychological patterns driven by collective human behavior. This theory is not about prediction. It is about probability, structure, and risk control. In this video, you will learn how professionals use Elliott Wave Theory as a map, not a crystal ball. The fractal market. Ralph Nelson Elliott discovered that markets are fractal. This means the same structure appears on a 1-minute chart and on a chart spanning decades. Why does this happen? Because markets are driven by people, and human psychology does not change with time frames. Time compresses, structure remains the same. This is why Elliott Wave applies to stocks, indices, forex, and crypto alike. Motive versus corrective waves. Elliott Wave operates on a simple engine. There are only two types of market movement. Motive waves move with the trend. Corrective waves move against the trend. Motive waves always subdivide into 5 waves. Corrective waves always subdivide into 3 waves. If you can recognize this difference, you already understand the foundation of Elliott Wave Theory. The 3 unbreakable rules. Elliott Wave has strict rules. Rule 1. Wave 2 can never retrace 100% of Wave 1. Rule 2. Wave 3 is never the shortest impulse wave. Rule 3. Wave 4 can never overlap the price territory of Wave 1. If even one rule is violated, the wave count is invalid. These are hard filters, not guidelines. The diagonal exception. There is only one exception to the overlap rule, the diagonal triangle. Diagonals appear at the beginning of a trend as leading diagonals or at the end of a trend as ending diagonals. In diagonals, price overlap is allowed. These patterns usually signal initiation or exhaustion of a trend. Fibonacci and mathematical precision. Elliott Wave is not guesswork. It is mathematically grounded in Fibonacci ratios. Wave 2 commonly retraces 50 to 61.8% of Wave 1. Wave 3 often extends to 161.8%. Wave 4 is usually shallow, around 38.2%. Wave 5 often equals the length of Wave 1. Targets are calculated, not predicted. The golden zone. The most important retracement area is known as the golden zone. This lies between 50 and 61.8%. This is where Wave 2 most often ends. Professional traders wait for price to reach the zone before considering entries. Patience is a strategy. The guideline of alternation. Markets avoid repetition. If Wave 2 is sharp and aggressive, Wave 4 will likely be sideways and slow. If Wave 2 is complex, Wave 4 will usually be simple. This guideline helps anticipate market behavior rather than react emotionally. Advanced corrections. Not all corrections look the same. Zigzags are sharp and fast. Flats are sideways and time-consuming. Misunderstanding corrections causes traders to enter too early and get stuck in consolidation. Structure matters more than speed. Complex corrections, Wave WXY. Sometimes corrections become complex. When multiple corrective patterns connect, they form a WXY structure. This does not mean the market is broken. It means the market is absorbing time and volatility. When in doubt, stay patient and respect the structure.
Please listen to the following disclaimer carefully. Registration granted by SEBI, membership of BASL, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. This content is for educational purposes only. The strategy discussed, specifically the moving average crossover, is strictly for illustrative purposes. It does not constitute investment advice, trading tips, or a recommendation to buy or sell any asset. Investments in the securities market are subject to market risks. Read all the related documents carefully before investing. Algorithmic trading involves unique risks, including system system failure, latency, and execution errors. Past performance is not indicative of future results. There is no guarantee of profits or protection from losses in stock market trading. Please consult a SEBI-registered investment advisor before making any financial decisions.
Elliott Wave Theory does not predict the future. It identifies where the market is within its cycle. It helps distinguish action from correction, momentum from consolidation. Trading is probability management. Elliott Wave is the map. This framework is based on the classic work of Ralph Nelson Elliott, refined through modern market application. If you want more professional trading education and structured analysis, subscribe to the channel. Trade the structure, respect the rules, and let probability work in your favor.